Hello, ladies and gentlemen. My name is John Guerard. I'm the Director of Quantitative Research at McKinley Capital Management in Anchorage, Alaska. And we're going to be talking today about robust regression in portfolio construction using SAS. Now, I appreciate the help of SAS allowing me to present this in a WebEx format. I'm terribly sorry that I could not be with you in Washington, D.C., as we were all looking forward to that. I want to tell you at the beginning today that our research that I'll be presenting today has been done in conjunction over the last 25 years with Harry Markowitz, the Nobel Prize winner, and Gan-Lin Xu. Harry and Gan-Lin serve on our scientific advisory board at McKinley, and we worked together at Daiwa Securities 25 years ago. In terms of my background, I was an undergraduate at Duke University in economics. I have a PhD from the University of Texas in finance. Now, I'm excited to be with you today, and let's talk about what we're going to be doing. First of all, we are going to be talking about three models in particular. We're going to be talking about a forecasted earnings acceleration model, a CTEF model. We're going to be talking about an 8-factor model, which we're going to designate REG8. The REG8 model has earnings, book value, cash flow, sales, and how these variables move relative to their 5-year means. We're also going to be talking, so we're going to be calling that equation 9. That has to do with the paper that has been submitted for the SAS forum. Okay, the next slide, please. We're going to be talking about regression 10, which is a 10-factor model. And to this model of earnings, book value, cash flow, and sales, we add our forecasted earnings acceleration model, CTEF, and we add a price momentum variable, a 12-month minus 2-month price momentum model as a alpha fringe. And so we have a 10-factor model. We have tested this model over the last 10 years. We have particular attention. We believe that the model is statistically significant in almost all universes, and we're going to be showing you those universes today. The 8-factor model was developed in 1993 and continues to be statistically significant. What we want to share with you today, and the reason we're so excited about this, is because of the fact that over the last 25 years, we have built and implemented models, and we've continued to test models for 2 primary degrees of testing. Number 1, we want to make sure that our model ranks securities such that we can use this for stock selection. This is our information coefficients, the ICs. And this has to do with statistical significance. You will find this discussed in our book in Chapter 3 and in Chapter 4 of the SAS Press book. The 10-factor model has updated research. It's statistically significant, and we want to make sure that we will show you different trade-off curves. See, the ICs are our first level of test. Our second level of test has to do with a full-blown Harry Markowitz efficient frontier with transactions costs from ITG and turnover constraints. We're going to turn over 100% a year. We're going to assume a traditional mean variance approach of 4% upper bounds ITG transactions costs, which average about 60 basis points each way going forward. Our next slide, please, and this is our summary and conclusions. We're going to tell you what we're going to tell you now, and we will remind you at the end. First of all, we're going to show you a forecasted earnings acceleration model that is highly statistically significant. This model was published in 1997 and continues to work post-publication, obviously post-sample. We're going to show you that momentum enhances portfolio returns, primarily in U.S. markets, non-U.S. markets, pardon me, over the period from 2003 to 2015. We're also going to show you updated evidence through 2018. So momentum works in the U.S., but works better in the international markets. All right, our next slide, please. Have markets changed since the publication of block Guerard, Markowitz, and Hsu in 1993, and Guerard and Andrew Mark in 2003. The answer is no. Over the 25 years since Block, Markowitz, Guerard was published, our models continue to work. CTEF, 8-factor models are highly statistically significant. The 10-factor model continues to dominate as well in international markets. And we want to stress two things in particular. Number one, our models will never be perfect, but they can be statistically significant based on ICs. And we're going to introduce a level 3 test, which is a data mining corrections test. And we will talk about those results today. And we passed the data mining test, which means that our models are statistically different from the average of the models that we could have tested, which includes 36 models, as we talk about in Guerard, Gillum, Markowitz, Hsu, and Wang. Now, if we go to our next slide, please. In terms of references, I want to stress in particular the first reference, portfolio and investment analysis with SAS, financial modeling for optimization. This is our SAS press book that came out last year. We also want to show you that our model has been done with many, many other models over the last 25 years. Rob Arnott has done a particularly great job of modeling. He, of course, is the research affiliates person. You can see our papers with Harry Markowitz that were published in the IBM Journal of Research and Development. And next slide, please. And also in the International Journal of Forecasting. The International Journal of Forecasting piece of 2015 is important because we talk about earnings forecasting, how the database, the IBIS database, was developed primarily in 1976 domestically, 1987 internationally, and most people started to look at IBIS forecasting in international markets around 1992. We did not have enough data at that time for our data mining corrections test in 1993 when we published our original paper, but we published a follow-up paper in 2015 in the International Journal of Forecasting. It is an Elsevier journal, highly peer-refereed, and this is interesting. We continue to work, Harry, Ganlin, and me, and you can see papers that are coming out in Annals of Operations Research with a special issue on data mining. We are always concerned with data mining. People talk about data mining. Harry and Ganlin published their original piece. Next slide, please. Harry and Ganlin published their original data mining corrections piece in the Journal of Portfolio Management in 1994. And we want to stress the fact that our models are statistically significant. There is a book that you should all be reading. It's Robust Statistics, Theory, and Methods. It's by Marana and Martin, 2019. It's actually by Wiley. And that's a book that people should be reading. It's what the SAS PROC Robust Reg is based on. So when you're looking at Robust Reg, that PROC is based on the work by Doug Martin and Marana. Next slide, please. Okay, so let's now talk about efficient markets. Do we believe in efficient markets? We believe, Markowitz, Guerard, and Hsu believe that markets are relatively efficient. What that means is the average person will not make money, but a person who has well-trained statistical and financial analysis and lots of computers can beat the market by a statistically significant level. And what we do in this table 1 is we show you paradigms and portfolio anomalies in the period of CompuStat, CRISP, and IBIS. That's the period from approximately 1976 to the current time. You see the work of Jaffe on insider trading, Latney and Jones. Latney, of course, is the great portfolio theory teacher at Chapel Hill. Elton and Gruber and Gultekin from 1981, their paper from Management Science is one of the most important pieces. That's where we came up with the underlying concept of CTEF. Next slide, please. Thank you. we continue to show you the history of financial modeling, the way we do it. You see Bloch and Guerard, 1993. Fama French came out about the same time in several of their papers. We have different variables and a different portfolio approach. We believe in traditional mean variance analysis. Next slide, please. We are not alone. I want to refer to the great work of Andrew Lowe of MIT with his price momentum work, the work of Bob Haugen, H-A-U-G-E-N, who did a lot of work on fundamental analyses. Bob is a brilliant person. He passed away about 3 or 4 years ago. Was a brilliant person. Burnell Stone is a co-author and a fellow Duke alum, and we've done lots of work together over the last 25 years. Next slide, please. The work continues. We continue to work on our data mining corrections test. We continue to find that financial anomalies are important. Buybacks right now are part of a variable that we use in our corporate exports variable, and that's in chapter 3 of our book. And you can see that work continues to be. Right now, you're going to see that the stimulus bill is basically coming down on companies that have been buying back for stock. The reason they're trying to do that, quite frankly, is the following. Buybacks have helped stock returns. And our corporate exports variable, which is driven by dividends and corporate exports in terms of buybacks, has been highly statistically significant the last 15 years. Next slide, please. Now, in portfolio analysis, if we were live, I would be holding up the Markowitz book from 1959, Portfolio Selection. MVM59 means we're going to create a Markowitz mean variance efficient frontier with a 4% weight on a global universe from December of 2002 through May of 2015. We're going to use the APT optimizer. We're going to pick a lambda of 200. Lambda is a measure of risk aversion. It's a fairly aggressive portfolio. A fairly aggressive portfolio. Now, if you look at this portfolio, we're going to compare Markowitz 1959 with Markowitz tracking error at risk, which is a First Amendment, kind of a friendly amendment, a first cousin to the original model, where instead of simply maximizing return, minimizing risk, we're maximizing return and minimizing the underperformance of a benchmark for the next year. So what happens with mean variance will almost always give you a higher active return and will almost always give you a higher active risk than tracking error at risk. However, models are highly statistically significant in terms of asset selection, the T statistics, 5.59 for the WLRR, that's our weighted latent root regression. That's in chapter 4. We're doing outlier analysis and collinearity modeling. So it's primarily the Beaton-Tukey robust procedure, the M method of 1974. And if you look at this analysis, you can see that number one, the information ratios all exceed 1. That's on the second line. We've taken into account transactions costs of 500 basis points each year. They are substantial tracking errors that you see of 11.5 on the traditional mean variance analysis, and the tracking error goes down to 9% with tracking error at risk. So that's why you would use a tracking error at risk. You can reduce your tracking error. If you used a lambda of 100 as opposed to 200, your tracking error would fall to about 7%. Obviously, the higher your lambda, the higher your information ratio, the higher your Sharpe ratio, the higher your geometric mean. So notice this, the benchmark of Markowitz, created in 1959, is an extremely hard benchmark to beat. Next slide, please. This is in the global universe. Now, for those of you that get excited about data mining, and we all do, we all get excited about data mining. This is our lambda of 200. We're producing lots of different models. Lots of different models. This is from our Annals of Operations Research paper that's forthcoming on the special issue of data mining. And we're using the BHY false discovery test. And this is what Campbell Harvey has popularized, the Benferi false discovery method. And if you look at all the models that have used, our weighted latent root regression that we used in 1993 for our first paper continues to be the second best model. Its t-statistic is 3.88. It's highly statistically significant. Notice LAR has a t-value in that chart of 3.84, and those are the monthly returns of your models. So our weighted latent root regression does extremely well. Notice for the individual variables, our CTEF, our forecasted earnings acceleration variable, has a t-value of 3.14. It's highly statistically significant, and models go down from there. Our overall model is highly statistically significant with those t-values. We can reject the null hypothesis of data mining. That's in Table 3. Next slide, please. Now, this is where we get excited, really excited. This is Table 4, where we're talking about robust regression. This is from our SAS Press book, Chapter 4. Look at the different methods we can use. We can use the M methods. We can use the MM methods. We can do the FAR, the Huber, the Tukey methods. And notice one thing that's important. All of the t-values for active returns are highly statistically significant. This is in the global universe. For active returns, specific returns are statistically significant for all of the 10-factor models. Notice momentum has high t-statistics. This is in the global model. So if you were to look at this, you would say, wow, robust regression is important. Which method of robust regression is not nearly as important as using robust regression? What an exciting conclusion. Next slide, please. Okay. Now, as we go through, we're going through a lot more of these slides. We're going to show you some returns now having to do with another universe, and this is our EM universe. And so as you go through these, we're going to show you different universes where they're applicable. The same results. You always find highly statistically significant active returns. What's your active return? Your portfolio return minus your benchmark. If you subtract out all your factor returns, then you get specific returns. You want your specific returns to have t-statistics greater than 2 for statistical significance. Next chart, please. And finally, oh, I'm sorry, this is the EM universe right here, because notice the higher values. The first chart, A, is non-U.S., B is global, C is robust regression of the EM markets. Notice you have much higher active returns, much higher specific returns, and momentum is positive, but not nearly as high a set of momentum returns over that period from 2002 to 2015 as the other universes. Momentum returns post-2015 have been extremely high. Next chart, please. Thank you. Now, so let me summarize what we've done. And that is the following. Here are our conclusions. Are markets efficient? No. Can we build models that are statistically significant? Yes. What factors do we use? We are using our public models at McKinley. See, we're an asset manager in Anchorage, Alaska, doing primarily global and non-U.S. stocks. I can't show you our real models, but I can our proprietary models, but I can show you our public models based on earnings, book value, cash flow, sales, CTEF, and price momentum. These factors have exactly the same exposures, the same attributes as our proprietary model. So I can show you our public model. And last but not least, I want to show you our picture of Guerard, Markowitz, and Shu. And so from our point of view, I say thank you for your time. We had 20 minutes. Conclusions, are markets efficient? No. How can we beat them? We have to look at forecasted earnings acceleration. We need to look at robust regression, and we need to use Markowitz mean variance analysis. You can use traditional mean variance analysis or mean variance analysis with tracking error at risk, the TAR method. The TAR method gives you high returns, higher active returns, high specific returns, but it lowers your tracking error. From the point of view of modeling, we've shown you different universes, and our models are statistically significant. Are models perfect? No, but they can be highly statistically significant. Our models are. We passed the IC test. We produce efficient frontiers that you can see in tables 4 and in chapters 4 and 5 of our book. In chapter 6, we do our data mining test, which we shared with you today. From table 3, our models are statistically significant. We're excited to be making this WebEx. Thank you so much. I appreciate your time. Goodbye.